Hi everyone, Chris Cordova here. Today we're going to go over the basics of how your Social Security will be taxed. Now this is something that can and should be projected into the future in more greater detail with some of the particulars of your situation, but the purpose of this is really to give you a general understanding of how it works, how Social Security will be taxed, just to clear up some confusion. So first thing to understand is that the maximum amount of your Social Security that will be included in your taxable income is 85%. Now the range is 0 up to 85%. So if you're not bringing in a whole lot of income in retirement, perhaps none of your Social Security will be included in taxable income. And on a worst case scenario, 85% of it will be added to your taxable income. So looked at in a different way, in a worst case scenario, only 15% of what you receive from Social Security will be tax-free. So let's get to how we get to if it's going to be 0 or 85%. And it's based on something called provisional income. So what's provisional income made up of? Well, it's made up of every type of income that you can be receiving in retirement. So what you want to do is add up what you're receiving from your pension, your IRA distributions, including required minimum distributions from the IRA, any capital gains or interest earned from a non-qualified account, any rental income that you'll be receiving, even any tax-free interest you might be receiving from municipal bonds or things of that nature, and of course any wages you might be receiving. So add all those up and then add half of what you're receiving from Social Security, and that all makes up your provisional income. One thing to note, that the only two sources of income that you can receive that will not be included in your provisional income is any income that you get from a Roth distribution or anything you might receive from cash value life insurance proceeds. Okay? So when we add all those up and you have your provisional income, then we go to a bit of a chart. And let's walk to the chart. So this is for a married filing jointly couple. It would, if you were single, these restrictions would be a little tighter. But let's go with, for simplicity, married filing jointly, just so you get an idea. So if your provisional income is somewhere between 0 and $32,000, then none of your Social Security will be included in your taxable income. If your provisional income is somewhere between $32,000 and $44,000, then up to 50% of your Social Security will be added in your ordinary income, your taxable income. And then if you're at $44,000 and above, then up to 85% of your Social Security received will be included in your taxable income. Now, this can be a bit deceiving, but it's bracketed out just like your tax brackets. So as soon as you get to $44,000, if you get $44,100, that doesn't mean you're 85%. You can actually have, depending on the situation, up to in excess of about $60,000 of provisional income and still not have the full 85% included in taxable income. So don't think that if you're at $45,000 you'll be at 85% added. It's probably closer to the 50 if you're in that scenario. So it can be a bit confusing, but it is kind of simple when we break it down this way. But again, it should be something that should be looked at in more detail in your situation, and I hope this gives you a little bit more clarification on how your Social Security will be taxed. Thanks for watching.